Hi, so a lot of you won't know, but over the past 2 years, I think I have evolved significantly from where I was. I used to look at big stable companies, the Googles, Amazons, Facebooks, Bank of America, stuff like that. And over the past 2 years, I have been reading a lot of books and absorbing as much information from Peter Lynch, Warren Buffett, Mohnish Pabrai, and many others. Then I read a book called 100 Baggers, and it's a fantastic book and has helped me refine my research. Then about 2 months ago, Mohnish Pabrai gave a fantastic lecture about how he is researching investment ideas as well. He talked about 100 baggers and that he is looking for what he calls spawners. So combining these ideas with the other books that I've read, I have developed an investing checklist, something that I go through when researching a company, and I actually pull this checklist out before I make a decision about a company. It helps me remember all the little things that I might have overlooked. Mohnish Pabrai explains this far better than me in his book, The Dundo Investor. Now, I get a lot of people asking me to make a course teaching investing, but look, I just don't want to make a course. I actually don't think you need a course either. Look, I didn't take a course and it's better to get lots of different opinions anyway. So in the description, I have a list of books that I highly recommend. I have read all of these books at least twice now, and I'm still getting a lot of value from them. So look, instead of going through a course, read all these books and that will be far, far more valuable. Okay, now the reason I'm making today's video is I'm just putting this idea out into the world to see what feedback I can get. See, from my eyes, this might be the type of company that could go 10x or 50x or maybe even 100x over a long period of time, maybe a decade or two. And if I found one of these and I invested, well, it would be a game changer. Okay, so the company is called Mastech Digital, and it is mostly an IT staffing company based in Pittsburg, America. Now, it was a pure IT staffing company, but over the past few years, it has been evolving. It firstly acquired a company in 2017 called InfoTrellis, which is a data and analytics business. Now, this business is a higher margin and faster growing area compared to IT staffing. Then, just recently, in October 2020, Masstech acquired another company called Amberleaf, which was a stagnant IT consulting company in Chicago. The plan here is to integrate this Amberleaf customer base with the better services and the bigger Mastech Digital. Now, I think this type of activity is a type of spawning, as Mohnish Pabrai would say. They are developing multiple revenue streams and adding extras to the core business. Now, look, taking a step back and trying to look at the overall industry, I think that a professional company that understands data and analytics and helps other businesses use data better is going to be important over the next decade. I think we all know that data is a really valuable resource, and companies that can use it better than others are going to get an advantage. So a company like Masstech helps other companies understand their data and use their data efficiently. And IT staffing is also an important service to provide, and I don't see this going away anytime soon. Staffing companies are affected by cycles in the economy, which doesn't bother me a lot as long as the company has a strong balance sheet and reliable cash flow, which we will check on these a little later. Now, I'm still digging into this company and I have some questions that I haven't had answered yet. So here are the questions that I'm looking for. Maybe someone out there could help me. So 1, I want to know more about exactly how Masstech helps a typical client with data and analytics. Look, finding IT staff is self-explanatory, but the data side, I want to understand more. Number 2, how many ongoing customers do they have? Is there some sort of order book? And the third question is, what is the average time a customer stays as a customer? Then I look at my checklist, and some of the other questions I asked myself in this section were, well, what famous super investors have invested in the company? Well, the answer is none. The second question I asked myself is the market cap less than $1 billion? And this is a big yes, the market cap is actually only about 200 million. The third question I asked myself is how big could the business be? And so we're looking here at the market potential. So look, if we look at the competitors, we've got Accenture at 180 billion, Infosys at 80 billion, and Cognizant at 40 billion. So besides the fact that no other super investors have invested, or maybe it's too small for a lot of them, or maybe they think it's a bad investment. Look, I don't know. Look, I'm happy with the industry they are in, and I'm going to give them a tick here. Taking a broad view would tell me that there is a lot of competition. So, trying to work out the competitive advantage is something that I haven't exactly worked out yet. A good way to look for a competitive advantage is in the financials. The numbers guide us whether there is a competitive advantage or not. Okay, now this is the net income for the company. Now, the InfoTrellis acquisition didn't make this dramatic of an impact to the net income, well, not as it appears. The company just went through a good period of growth as business confidence was up and unemployment rates in the US were very low. This is probably more the cycle being strong than anything. Now we move on to book value, and great book value growth here. Clear to see the company is getting bigger and bigger, growing at about 13% per annum over the last decade. Looking at revenue, well, it's also growing nicely, but look, not quite as fast, closer to 8% since 2011, but very reliable and consistent. I think it could grow faster now with the recent acquisitions. The data and analytics part of the business is only about 15% of the entire business, but it is growing at about 30% per annum. Okay, now this is the operating cash flow, and this is the first red flag here because it's a bit inconsistent. Look, I haven't worked out exactly why yet, but I'm going to dig back through the annual reports to work this out. Now, turning to the gross margins, now improvement does give a good indication of a company with some sort of competitive advantage. But this might have more to do with the better margin acquisitions rather than competitive forces. So based on the book value of the business growing at 13% per year over a 10-year period, plus I expect the acquisitions to help expand the business as well, I feel pretty good about using 13% as my growth rate moving forward. But regarding a clear competitive advantage, well, I haven't solved that puzzle yet. So far, they have been growing and winning business, but I haven't worked out exactly what makes them better than the competition. Look, this might take a while for me to work out. Okay, the blue and red areas here are the founders. So that's Ashok Trivedi and Samil Wadhwani. And the purple section is Vivek Gupta, who's the CEO. Between the three of them, they own 2/3 of the company. This is a great indication that the people running the company are heavily invested like the other shareholders, and I like this a lot. Return on equity isn't always consistent, but on average it is about 15%. Return on investment, which is pretty much the same as return on invested capital, had a good 2019 and even a better 2020, which this graph doesn't show, but again, not super consistent here. Okay, now moving on to the balance sheet. Regarding debt levels, the company has nearly got it down to zero after that 2017 acquisition. I like seeing the management team prioritizing paying down debt. But goodwill is at 44 million out of the 88 million in total assets. Now, I don't like this, but that is how acquisitions are added to the balance sheet. I prefer that goodwill number to be just not as big of the asset pie. What goodwill actually is how accountants value the brands of the company. So look, saying that the brand is worth half of all of the assets, look, I don't know. I think it's a bit subjective from the accountants. I'm not that comfortable with it. I prefer real hard assets like cash in the bank and things like that. Speaking of cash in the bank, since that 2017 acquisition, cash has been building up again. I can see why they were ready to acquire Amberleaf back in October. Now moving on to free cash flow, and this bothers me. It has been great the past couple of years, but before that, how am I supposed to get a read on the company? I guess through the consistent increasing of the book value, but I still like to see stable free cash flow. And that's not what we have here. But on the other hand, maybe things are just starting to really get going. It's just a bit hard to tell. So I've shown you a lot of metrics and graphs, but what does it all mean? Well, it means that the answers are not easy to find and things are not that clear. I think I want a bit more consistent data and better return on investment as well. I think this is a wait and think, and I don't think I need to rush. Firstly, I'll take that 13% growth rate that I was predicting moving forward. By the way, since it is a microcap company, we don't have analysts giving any opinions. That's totally fine, we don't need them. The lower the price we pay, the more upside potential we have, plus the less risk we're gonna take. So price is unbelievably important. And I like minimizing my risks, so the best way to do that is to pay far lower than fair value. So price to free cash flow is the relationship between the stock price and how much free cash flow the company is making. I then factor in a growth rate to get a target price to free cash flow number. This is a really rough way to just value a company, but it's pretty good to get a ballpark figure and then compare that to my other method, which is the discounted cash flow method. Now, free cash flow I know hasn't been growing at 13%. But let's just use our 13% as our ballpark growth rate here. Now, Masstech's current price to free cash flow is just 10, and that would tell us that it probably is undervalued. Now, if I go and look at my fair value calculation, which factors in more information, and if you want a copy of this, it's free and it's in the description. Using 13% growth rates and a little less after that, plus I took a little off the free cash flow as, look, free cash flow, like I said, hasn't been consistent in the past, and I wanted a big discount rate here of 25%. So a price around $15 would give me a pretty big margin of safety. The price right now is about $17, $18, so it's really not that far away. Okay, so the negatives are these. There's an unclear competitive advantage, something I want to work out and will keep looking for. There's no super investors invested, the cash flow growth is inconsistent, and return on invested capital isn't consistent either. But there are positives, and they are that they're in an important industry for the future, and they have lots of room to grow and spawn new areas of their business. Their market cap is perfect, smaller is better. Their book value, revenue, and margins have all been improving, and these are really good signs. Debt levels are really good, and the buy price is pretty interesting at $15. I have a big margin of safety that would take a lot of potential risk off the table. So honestly, I don't know right now if this is a good company or not to invest. I'm going to keep learning about it and follow it along. If I miss out and it goes dramatically up, that is totally okay. I know that I'm not ready to invest in it right now, and I don't feel I need to rush. There will be something else out there that I might like better anyway. One of the cool things about investing in my style is that I can just say no like 99 times and only need to say yes just like once. So if I'm not ready, I'm not ready. And don't forget to subscribe so you don't miss any of my future videos, and hit me up in the comments if you have an opinion about Masstech, as I would love some feedback about this one. And don't forget about the books in the description below if you're trying to learn more. And obviously you will need to investigate a lot further if you want to invest yourself, but this hopefully has got you started. Thanks for staying to the end, and I'll see you in the next video.